Thank you. I never thought the day would come when I would be entering a room to ABBA. But that day has come. Frank Bisignano gets Pink Floyd and I get ABBA. I have to talk to the organizers. Thank you, everyone. Very excited to be here. This is a pretty amazing crowd. I think this crowd is really a testament to the very, very dynamic nature of the changes that are happening right now in payment systems. It's really an exciting moment. Obviously, the face of banking, as we know it, is changing before our very eyes. It's really in a state of metamorphosis. And the changes we're seeing right now, driven by technology, are happening before our eyes. The changes we're seeing when it comes to virtual currencies are really just one aspect of that. Broadly speaking, I think these changes are resulting in really a fascinating collision between two very different things. And one of those things is the very tightly regulated world of banking. And it's colliding with the very unregulated world, largely unregulated world of innovation, of tech. And I think what we're all working through right now, as an industry, but also as regulators, is how that collision is going to work itself out as we go forward. And the debate over regulation of virtual currency is really just one aspect of that larger collision and how it's going to work out. I'll tell you, where I work at the Department of Financial Services in New York, virtual currencies got on our radar screen for a very simple reason, which is we regulate money transmitters like Western Union and MoneyGram. But as you might imagine, our statutory scheme was put together and written long before there was an internet, let alone virtual currencies. So our initial focus last year when we started looking at virtual currencies was how to deal as a regulator with virtual currency entities who might be engaging in money transmissions, which would mean the department, our department, has a specific legal responsibility to license, examine, and regulate those firms in New York. Now, indeed, those responsibilities go to the core safety and soundness work that DFS does as a regulator to protect consumers. And moreover, there have been very serious and documented concerns about the use of virtual currencies for illicit activity and for money laundering. The Liberty Reserve and Silk Road cases are perhaps the most notable examples, but sadly, I'm sad to say that this illegal activity has only grown since those cases were brought. So in August 2013, our department launched an extensive inquiry into the appropriate regulatory guardrails to put in place for virtual currencies. Now, let me just step back for one moment. I get asked a lot by people who are not in this room, people who are not in this world of payments and technology and virtual currencies. I get asked, why does any of this Bitcoin stuff matter? And for those people, it's a fair question because they still don't comprehend what Bitcoin is, and they certainly don't understand what it could offer in the future. But I can tell you that in New York, at our department, after we began looking into virtual currencies more closely, it became very clear to us that the power behind the technology is pretty amazing. And I don't think any of us knows exactly how virtual currencies are going to shake out over the next few years. The tech is obviously going to continue to change and evolve and likely improve. And platforms are going to be built upon platforms. And probably the most interesting and successful utilization of virtual currencies haven't even been imagined yet. But it does appear that at the very least, virtual currencies hold the potential to provide several important things that I think you all are quite familiar with, like one, much cheaper fees for transactions, two, frictionless transactions all over the world, even into countries with no modern banking system, and all of this with far less potential for identity theft. And those are just some of the basics. Programmable currencies, of course, hold many interesting potential applications and efficiencies. And it's also worth noting that virtual currencies, if they continue to take off and become more popular, that they will challenge to some extent the payment systems that exist at our largest banks. And that could cause those banks to really up their game and improve their own payment systems, which would be a benefit to all of us. So to be clear, at DFS, we think that virtual currencies matter, and we're excited about the potential that they hold to improve our system in various ways. As I mentioned, virtual currencies can, of course, be abused. But that's, of course, true of our traditional banking system, where we have at times seen fraud, money laundering, etc., at some of the world's largest institutions using good old fiat currency and doing it on a massive scale. Now, in January of this year, at DFS, we held hearings on virtual currencies with the hope of getting really a 360-degree view of this new and constantly evolving industry, both its promise and its potential pitfalls. We sought to bring together a diverse group of witnesses with an array of different perspectives. We really believed that it was appropriate to hear from law enforcement and regulators, but we also wanted to bring in investors, technologists, merchants, and a number of other individuals on the ground floor of this fledgling industry to provide their views. Now, those hearings, as well as our broader inquiry into this area, not only taught us a lot about the industry, but it also sparked a lot of debate, a lot of healthy debate. And we certainly benefited from that debate, which is still going on today, because the regulation of virtual currencies requires us to come up with appropriate guardrails, as well as licensing, examination, and collateral requirements, while at the same time not stifling innovation and not crushing a fledgling industry. So, as we were proceeding with our inquiry after the hearings, we initially thought we would take our time and put out an initial proposed regulatory framework by the end of this year, the end of 2014, for public comment. However, the collapse of the unregulated virtual currency exchange in Japan, you all know as Mt. Gox, a company at which millions of dollars worth of consumers' Bitcoin essentially vanished overnight, made us accelerate our timeline. That event, the collapse of Mt. Gox, underscored for us the risk consumers run when entrusting their money to an unregulated financial institution, whether for Bitcoin or for any other financial product. In other words, that is precisely why we have financial regulation. Now, we're not fooling ourselves. It is impossible to fully eliminate all the risks financial consumers face, and there have been times when regulators have fallen down on the job, such as our last financial crisis. But effective and appropriate government oversight can play an important role in reducing the risks of fraud, mismanagement, and abuse for financial consumers. Moreover, as some segments of the Bitcoin community itself have noted, poorly run exchanges and the doubts they foster among consumers are a serious threat to the wider adoption of virtual currencies. And when Mt. Gox collapsed, there was no regulatory body ready to step in and get timely answers for consumers. Instead, there was radio silence. I can tell you the day Mt. Gox collapsed, I know exactly where I was. I was in Basel, Switzerland, at a meeting of international financial regulators, about 20 different countries represented. And I got a call from my office telling me what had happened with Mt. Gox collapsing. And at a break of that meeting, I took aside the Japanese regulators and offered our assistance and said we would put our virtual currency team, some of them on a plane to Japan as soon as they wanted to help them. Unfortunately, the Japanese regulators had no idea what I was talking about, and that underscored for me the dangers when a large financial entity goes totally unregulated. Now, ultimately, after the Mt. Gox collapse, we redoubled our efforts and put forward our proposal for public comment 6 months ahead of schedule in July of 2014. That regulatory framework included a number of key provisions to safeguard customer assets, protect consumers from fraud, root out money laundering and other illicit activity, and put up strong defenses against would-be hackers by emphasizing the need for robust cybersecurity. Now, to be clear, our proposal was meant as a beginning, not an end, to a healthy, vigorous public discussion about what the final regulation would look like, and we certainly got that. We wanted to move quickly to put in place rules of the road for virtual currency firms to provide greater clarity and certainty about the regulatory environment, but not move so quickly that we risk mistakes. To that end, while we put forward our proposal for public discussion ahead of schedule, after some members of the virtual currency community asked for additional time to formulate their feedback, we listened and we doubled the length of the initial comment period. Indeed, I think there may have been some people who mistakenly assumed that our initial regulation was a take it or leave it, all or nothing proposal that would take effect in a matter of days or weeks. Actually, when we do regulations, and especially regulations in areas of entirely new technologies, we engage in a very iterative process, and we like to have a robust give and take. It's just vital to getting things right. Truth be told, public comment periods also generally take a good deal of time in government. So we are likely to make some additional changes to our initial proposal and clarify other provisions. And state law provides for an additional comment period when an agency makes new changes to a proposed regulation, which should provide a further opportunity for public feedback. So our public comment period has now ended. It ended on October 21st. I would anticipate that we'll have a new draft of the regulation around the beginning of December. And that will then trigger another 30-day period of comments, which we look forward to. And I would assume we would then have a final regulatory framework, final, sometime early 2014, hopefully in January. Now, while we'll be making substantive changes to the regulation, and we very much appreciate the time so many people took to formulate and submit comments. I've read many of them myself, and I can tell you many of them are excellent. We do think that many of the original proposals make sense, are good for consumers, and they are good for the long-term health of the virtual currency industry. The rules also generally mirror the types of requirements that other banks, financial institutions, and money transmitters have to live by, with some alterations owing to the unique nature of virtual currencies. Now, this is a point that is not well understood, in part perhaps because virtual currencies sit at a crossroads, as I mentioned, of the more lightly regulated technology sector and the more heavily regulated financial sector. There is a basic bargain that when a financial company is entrusted with safeguarding customer funds and receives a license from the state to do so, it accepts the need for heightened regulatory scrutiny to help ensure that a consumer's money does not just disappear down a black hole. And most of what Bitcoin firms are being asked to do, whether it is examinations, anti-money laundering compliance, accounting, or record keeping, is similar to what other financial firms must do. Additionally, we agree with the sentiment that financial regulation should be, wherever possible, and to the extent practical, technologically neutral. But we can't stick our heads in the sand about the fact that when it comes to consumer disclosures, capital accounting, and other issues, there are certain real differences between fiat currency and virtual currency. What we should do is endeavor to make sure that where there are technologically specific regulations, they are as narrowly tailored, reasonable, and warranted as possible. Moreover, to the extent that there are some specific areas of the regulation that are somewhat stronger or more robust for virtual currency firms than we have for other financial institutions, and I think I'm talking here mostly about our cybersecurity rules in the proposed reg, that is primarily because we are actually considering using the cybersecurity rules in the Bitcoin reg as a model for the rest of our regulated institutions. I think, as evidenced by the recent JP Morgan hack and numerous other hacks we've seen, cybersecurity is rapidly becoming one of the most important issues any regulator, and I think, frankly, the financial system will face over the course of the next year or two. And you'll be hearing a lot more from our agency about this. I think you'll be hearing a lot more from a lot of different agencies about this. In the Q&A we're going to have, I'm happy to separately discuss cybersecurity and what needs to be done there as much as you'd like. Now, as I noted, there are some important changes we're going to be making to the proposed regulations, many of which I expect will be clarifying in nature. We've discussed some of those expected changes recently in public, but let me just outline them briefly here as well. And I also want to add a few new additional changes we're considering. First, there is some confusion about who will be required to obtain a BIT license. For example, some believe that our proposed regulation will require all software developers and all individual users of virtual currency to obtain licenses. So let's be clear about this. We are not regulating software as software. We are not regulating software development. For example, a software developer who creates and provides wallet software to customers for their own use will not need a license. We are regulating financial intermediaries. That's what we're supposed to be doing. We are not regulating software development. Let me repeat that one more time. We are regulating financial intermediaries. We are not regulating software development. Now, individual users are similarly exempt from the license requirement. People who want to use virtual currency to make purchases or want to hold virtual currency solely for investment purposes will not be required to obtain a license. And we'll make all of this clear in the revised reg. Second, there appears to be some concern that virtual currency businesses will need to get several different types of licenses, resulting in a cumbersome and duplicative application process. To the extent an applicant requires both a money transmitter license and a virtual currency license, for example, which could be possible in certain circumstances, the process will be streamlined. Applicants will be able to cross-satisfy the requirements of each license. Third, we have received comments claiming that banks are completely exempt from complying with the virtual currency regulations, and that is not fair. That, of course, would not be fair. However, it also isn't true. The banks we regulate cannot start providing virtual currency service without prior approval from the department, and they will have to comply with any requirements that are otherwise imposed on virtual currency businesses. Now, fourth, there has been much speculation about whether we intend to regulate mining. Again, I want to be clear about this. Mining and mining pools per se will not be regulated. To the extent a miner engages in other virtual currency services, however, for example, hosting wallets or exchanging virtual currency, a license might be required for those activities. So those are some of the changes we've previously outlined, but let me address one new additional area that I think is of great interest to at least some of you. One issue we've heard about consistently throughout the entire comment period is a concern about the compliance costs of regulation, especially for new or fledgling virtual currency enterprises. Now, this is a difficult issue, and we've been wrestling with it for months. There has to be a way for startups to start up and to play by the rules without getting crushed by huge compliance costs. To that point, we are considering creating a special type of transitional bit license, which would allow certain small businesses and startups to operate within a more flexible framework for a set period of time, during which time tailored examinations would be conducted. Now, in other areas at DFS, we have at times exercised some flexibility to tailor the types of guardrails and protections we put in place based on the risk profile of an individual firm. We see the benefits of doing something similar here. In considering whether or not to grant a transitional bit license, we could consider, among other factors, the nature and scope of the applicant's business and the associated consumer risks, anticipated transactional and other business volume, whether the entity is registered with FinCEN as an MSB, and the mitigating risk controls already in place, for example, a bond or other insurance. Now, to be clear, we will not waver in our commitment to protecting consumers and preventing illicit activity. We can't turn away from the vital task of preventing money laundering, which sometimes facilitates truly unspeakable crimes. And any firm that engages in misconduct will face real penalties. Moreover, firms will still have to meet strong standards for consumer protection, anti-money laundering compliance, and capital standards. But for example, they could potentially, a small startup could potentially use an outside vendor rather than a separate internal compliance officer for certain functions. We're also considering at DFS designating a specialized group of examiners to handle the licenses and applications for startup firms. That will give that group of examiners some expertise and some real understanding of what startups are going through and will enable us to more appropriately hone the transitional bit license in a way to allow those firms to get through the process. Ultimately, we will continue to strive to strike an appropriate balance of virtual currency regulation that helps prevent conduct that is harmful to consumers and public safety while still permitting beneficial innovation to proceed. And it is our hope that innovative new companies committed to doing things the right way will want to do a lot of business in New York, the financial capital of the world. Companies can, of course, try and run from regulation in a race to the bottom, to set up shop in dark corners of the globe with little to no oversight. I can tell you personally, I find it depressing and dismaying to hear some companies threaten to not do business in New York simply because we believe there need to be regulatory guardrails. Some firms will even play one regulator off another to try and water down the rules, a process we call regulatory arbitrage. We saw this phenomenon a lot during the lead-up to the financial crisis. But our hope is that companies recognize that effective, appropriate regulation will help create a race to the top. That smart, tailored regulation will foster greater trust and confidence among both customers and investors who want to do business with firms committed to consumer protection. And that will spur a virtuous cycle of greater adoption of virtual currencies, a cycle where it is possible to innovate, make a profit, and play by the rules all at the same time. So at a basic level, our guiding principle for virtual currency regulation is similar to our guiding principle for regulation at all financial companies. We have never been an agency that supports regulation for regulation's sake. We simply want to make sure the appropriate guardrails are there to protect consumers, and at the same time we help prevent illicit activity. When it comes to safeguarding customer money at a financial company, an unregulated world of caveat emptor has never been a sufficient answer. Now right now it seems that the virtual currency industry is at a crossroads regarding whether it will become an important part of our financial system in the future. At DFS we're committed to proceeding thoughtfully, since virtual currency could ultimately have a number of benefits, as I've outlined, for our financial system. Events and discussions like this one really help as we strive to right-size and modernize our regulation of new financial technologies like virtual currency. I very much look forward to getting your questions, to learning more from all of you today, and I want to thank you for the opportunity to speak with you today, and I really look forward to our give and take. I want to now ask Jacob Farber, I think, is going to come out here from the law firm of Perkins Coie and help moderate the Q&A session. But I very much thank you for your help.